If the definition of a dollar is changed and devalued against gold, it is really a devaluation of treasuries, and therefore interest rates are going to skyrocket very shortly after this gold revaluation. And I don't think it will take very long for the end game to hit once this is actually done. We've seen how it affects prices in the past. We know this one is going to be a lot huger than the one that was in 1933 or the indefinite one that was put in place in 1971. This one is going to be monstrous and is going to lead to the end of the Treasury market and the end of the US dollar as a fiat currency. And then everything is going to be repriced in terms of gold and silver, of course, when the public realizes it can't get any gold and the only thing that it can get its hands on are perhaps a few ounces of silver, and then we will head into a new era.
Rafi Farber from the Endgame Investor says revaluing gold is essentially the same thing as devaluing the dollar, and by extension, U.S. Treasuries. That shift would send interest rates soaring, crush the bond market, and shatter confidence in the currency itself. The 1933 revaluation proved this dynamic. Back then, it devalued the dollar, but it also created significant disruption and controversy, leaving lessons that still weigh on any modern conversation about gold. Farber argues the fallout wouldn't be limited to the U.S. If Washington were to revalue its gold, other central banks would have no choice but to follow suit. Physical gold prices would leap far beyond the new official peg. For most people, silver would be the only accessible alternative, setting the stage for a surge in demand that could spark a genuine monetary reset. There are already signs this shift is underway. Delivery requests at COMEX and the London Bullion Market Association are at historic highs as institutional buyers increasingly insist on taking physical possession rather than relying on paper claims. Farber explains that history shows gold revaluations are always inflationary, but this time, the scale would be enormous. It wouldn't just dent the dollar, it could undermine its standing as a fiat currency altogether, forcing the global system to reprice everything in terms of gold and silver. These discussions come at a moment when de-dollarization is accelerating. Central banks have been adding gold reserves at the fastest pace in decades, and gold recently overtook the euro to become the second largest reserve asset worldwide. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
August 1st, some guy who works for the Fed who has a degree in BS economics. I know it's a BS in economics, but what's the difference really? He published an article on the Fed's website about the prospect of gold revaluation in previous gold revaluations that have happened and how they basically had no effect on anything important, except the three cases of gold revaluation that he cites are completely insignificant relative to the ones that he does not cite, and those are the one in 1933, which revalued gold 66% higher from 21 to 35, and the devaluation of the dollar in 1971 relative to gold, when the final gold window was finally closed. But he doesn't mention either of these and their effect on inflation, or what he calls inflation, which is the rise in consumer prices. I will show you how gold revaluations severely affect price inflation as defined by the Keynesians with two simple charts, and why this gold revaluation, if and when it happens, is going to be at least 60 times worse because the revaluation would be a mark to market. And even assuming the market price remains at 3,400 whenever this passes, and it won't remain there, the effect of a gold revaluation on the dollar and prices will be extreme, and it will lead to the end game almost certainly. One thing I noticed on Gold Charts R Us. This is a great site that I have a subscription to, and I recommend if you really follow the gold markets, it is very helpful. I looked at the gold future spread because I noticed that there was a record low spread between the 2-month and spot rate, which we'll get to in the next chart. With public debt at high levels, some governments have begun to explore financing additional expenditures without raising taxes while also not increasing public debt outstanding. One possibility is using proceeds from from valuation gains on gold reserves as has been floated in the US and Belgium recently. For the US, this would involve revaluing the government's 261.5 million troy ounces in gold reserves, the largest gold reserves globally, from a statutory price of 42.22 per troy ounce to current market prices, which stand around 3,300 per troy ounce. Now it's 3,400. So what would that mean? If you read this article, which I'll put in the link in the description below, it's full of a bunch of crap, which talks about some insignificant gold revaluations in the past few decades, but totally ignores the big one in 1933, 1934 of $21 to $35 a troy ounce, and then the big one in 1971 from $35 per troy ounce or $42 per troy ounce to whatever the market says, which was a gold default. What happened to prices in both of these circumstances? We're going to look at food prices in the immediate aftermath of these revaluations. You'll see it's not good. Here's what Craig Hemke says on the situation. I will link his article in the description below. In the end, Craig says, connecting all the dots for this picture is about as simple as a children's workbook. The politicians are warning you that an official gold evaluation is coming, and the price action since Trump was elected is telling the same story. The only question, what becomes of the market price for gold when this official revaluation happens? And he says, no one knows. Seriously. Well, I do. I just don't know exactly how long it's going to take from the official revaluation to endgame. I don't even know if we're going to make it as far as an official revaluation before the market forces it. But anyway, I'm going to finish this paragraph and then explain why I believe this is so. How could anyone be certain, as no one alive today has lived through the unofficial U.S. government evaluation? Well, I would say that we can still look at the data of an official U.S. government evaluation, and some people who are alive today have lived through it, those who were born in the 1920s and they're centenarians, and they were teenagers when it happened in 1933. Some of them are still alive, and we can find some of them. Anyway, if the U.S. just simply uses a London PM fix of, say, June 15th, 2026, and what does that mean for the gold price on June 16th? Probably nothing. However, it speaks volumes regarding the value of gold as something other than a barbarous relic. Additionally, other central banks and governments around the world may follow suit and issue their own official revaluations. Absolutely. If the U.S. government revalues its gold, of course, the other governments of the world will revalue theirs. And usually we're talking about the central banks here and not the government. But why do I think that the price of gold will head up higher very fast when there is an official gold revaluation mark to market? Well, here is some of the evidence, and then I'll give a logical explanation. First of all, the gold revaluations and inflation below was a 66% revaluation. This one would be 60 times larger than that because we'd be revaluing gold from $42.22 to about $3,400, which is 60 times larger than the 66% revaluation of 1933. So here you can see these are food prices. I'm going into food prices because I want to know how a gold revaluation was followed. I'm not necessarily going to say affected by directly, but was followed by a huge spurt in food price inflation increases, which means that basic necessities got extremely expensive once the revaluation happened shortly after. You can see here that April 1933, food prices were going down 15.3%. By March 1934, less than 1 year later, food prices were rising at an annual clip of 22.3%. This was only on a 66% revaluation of gold, meaning devaluation of the dollar. Here is the August 1971 gold default. You call it a revaluation, dollar devaluation. It's all the same thing. The August 1971 gold default went from a 3.5% rate in food price inflation in August 1971 to 20%, 19.8% by August 1973. Just about 2 years later, we had the major stagflation of the 1970s, and the only way it was brought down was by the Treasury selling its gold reserves off to try to suppress the price of gold. And now, from a logical, positivist perspective, why would marking gold to market raise the price of physical gold enormously and then lead to huge amounts of food price inflation, which is really the most important part of the Keynesian definition of inflation, because when basic necessities become unaffordable, people start to riot. There are several ways to think of it. The simplest one is this, that gold at the Fed on its balance sheet is not convertible. You cannot go to the Fed with your dollars and get the gold that it has in its basement. What you can do is you can buy gold at a coin shop.
Rafi Farber notes that the overlooked reality is that gold revaluations have consistently triggered massive inflation, most notably in food costs, the kind of inflation people experience every day. In 1933, when Roosevelt revalued gold, food prices dropped 15% annually. The same pattern repeated after Nixon closed the gold window in 1971. Food price inflation, which had been just 3.5%, soared to nearly 20% in less than 2 years. That spike was the trigger for the stagflation decade that followed. Turning to the present, Farber points out that gold itself has been consolidating for nearly 4 months, but gold miners have already broken out. Historically, when miners lead the way higher, gold tends to follow. In August alone, mining stocks rose by around 25%, while gold prices remained relatively unchanged. That divergence suggests the consolidation may be nearing its end, with miners signaling the next leg up for bullion. Costs to borrow gold for just 2 months have surged above 3.1%, the highest ever recorded. Elevated leasing rates indicate tightening supply conditions, and in some cases, they suggest backwardation, where gold is currently trading at a premium to gold delivered in the future. Let's get back to the interview.
1,295 grams per ton silver at the galleon target, 3.8 grams per ton gold at the horseshoe target. We've got copper, zinc, lead, antimony, gallium, indium, and tin. Rumor has it that Putin will be there soon, and he might take a look at the resources. I don't think he actually will, but it's an interesting coincidence. Now with that, let's go to the charts and an explanation why a gold revaluation would lead to a quick dollar devaluation from an Austrian school positivist logical perspective. For our first chart today, people have been asking me how long is this consolidation in gold going to last, and silver as well. Well, we're at nearly 4 months now, or a little bit past 4 months, about 4 months. We can see here that the candles are the price of the gold miners as represented by the GDX and GDXJ ETFs. We can see here they are both headed higher as of the beginning of August relative to gold, which remains in consolidation. The miners have broken out. When the miners tend to lead gold, that means that gold usually is at the end of its consolidation. Miners usually lead gold in their move. If miners are headed down and gold is not yet, that usually means that gold is headed for a dip. If miners are headed up and gold is not yet, that usually means that miners are leading gold higher. This consolidation is about to end. In my humble estimation, that is. You can see here that miners are up about 25% for the month of August, and gold has been relatively static. Where are we in terms of how nervous the Treasury is getting before there is something bad that happens in the monetary system? Well, it looks like Scott Bessent, our favorite Treasury Secretary, is getting pretty desperate because he's begging the Fed to cut rates 150 basis points from Bloomberg. U.S. Treasury Secretary Scott Bessent made his most explicit call yet for the Federal Reserve to execute a cycle of interest rate cuts, suggesting the central bank's benchmark ought to be at least 1.5 percentage points, that is 150 basis points, lower than it is now. I think we could go into a series of rate cuts here, starting with the 50 basis point cut in September. That's what he wants. Bessent said in a television interview on Wednesday, if you look at any model, whoa, those models got to be hot. It suggests that we should probably be 150, 175 basis points lower. I wonder what model he's looking at. It costs to lease gold for 2 months. It costs here 3.18%, which is an all-time record high. This was about 2 days ago. And so this is one indicator of gold backwardation. I don't think it's going to stick yet, but if gold is flirting with backwardation because gold now is worth more than gold in the future, which is a backwardated state. And another word for endgame is permanent gold backwardation. The gold that you can physically hold in your hand is worth $3,400, and that is the premium that people are willing to pay over the gold that you cannot, which is $42.22. Now, if they market to market, that means that gold that you cannot hold in your hand is worth $3,400. Then therefore, what is the premium gold that you can actually own yourself? Well, we don't know exactly what that premium is going to be, but it's going to be a lot higher than $3,400. And it could take a few days or a few weeks or maybe a month to catch up for the premium to start to rise. But recall that the strongest gold rally in history was from 1971 to 1973, which was even stronger in percentage terms than the rally from 1978 to 1980. I know often it doesn't seem that way, it's not thought of that way, but the strongest rally in gold was right after the revaluation or the devaluation of the dollar in 1971. We're going to see something very similar in gold prices if and when there is an official gold revaluation. The other way to think of this in terms of the Misesian regression principle is that all transactions in dollars are based ultimately on promises for gold because that is how the dollar was born. And because all economic transactions today flow from all economic transactions in the past, it's like thinking about time travel. If you go back in time and change an event in the past, it's going to change all events in the future. So if you change economic events in the past, obviously they will also change economic events in the future. And the economics events of today are still based on the assumption that gold that is owned by the Fed is payable at 42.22 an ounce by dollars, which are the Fed's liability. I understand that people do not actually believe this, but because the economic transactions of today stem from those of yesterday and prices of today stem from prices of yesterday in gold terms, that means if the definition of a dollar is changed and devalued against gold, it is really a devaluation of treasuries, and therefore interest rates are going to skyrocket very shortly after this gold revaluation. And I don't think it will take very long for the end game to hit once this is actually done. We've seen how it affects prices in the past. We know this one is going to be a lot huger than the one that was in 1933 or the indefinite one that was put in place in 1971. This one is going to be monstrous and is going to lead to the end of the Treasury market and the end of the US dollar as a fiat currency. And then everything is going to be repriced in terms of gold and silver, of course, when the public realizes it can't get any gold and the only thing that it can get its hands on are perhaps a few ounces of silver, and then we will head into a new era.
What's striking is how these patterns keep circling back. Each time gold's official role has been altered, the fallout has gone well beyond financial charts. It's reshaped daily life, trade balances, and even the political climate. Today, the signals are flashing again. Bullion withdrawals are hitting records, leasing rates reveal growing strain, and mining equities are running ahead of the metal itself. Layer on top the growing global pivot away from reliance on the dollar, and the stage looks set for another historic recalibration. If it comes, it won't just be a technical adjustment. It could redraw the hierarchy of currencies, lift silver into an even more prominent role, and rewrite how value is measured in the global system. Could the following adjustment in gold's standing act less like a policy tweak and more like a shockwave that permanently resets the foundation of world money? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.